In today's world, life without banks would be impossible. From our homes, groceries, cars, vacations and education to trade, agriculture, commerce and industry, every segment of society is dependent upon banks. Even governments need banks to perform their functions more efficiently and effectively. Although banking in one form or another has been in existence for ages, modern banking, that we see today, is of rather recent origin. The biggest characteristic of banks is that it bridges the void existing between surplus and deficit segments of a country or region. At one end are people who have more money than they need or can spend. Hence, they look for opportunities which are safe, liquid, and remunerative. On the opposite end are those people who have profitable business opportunities but are short of capital. Banks stand between these two extremes. It borrows money from the surplus segment, at a lower rate, and lends it to the segment which is short of funds, at a higher rate and, in this way makes profits. But profit is not the only advantage that accrues from banking. The real advantage is accumulation and channelizing of national savings into investable opportunities. Now let's have a look at the formal definition of a bank. According to Banking Ordinance, a bank is a financial institution, which accepts money from the public for lending or investment, repayable on demand or withdrawable by checks, drafts or transfer. In simple words, bank is any organization which is established with the minimum required paid-up capital and is authorized by the central bank to accept public deposits, honor checks, collect checks, and advance loans. There are many types of banks such as commercial banks, microfinance banks, merchant or investment banks, and several types of specialized banks, such as agricultural banks, industrial banks, and mortgages banks. We will discuss what each of these types of banks does in the next chapter. Our first lesson in banking concludes here. Thank you for watching.